Good morning, everybody, and welcome to this BDO Financial Reporting Update webinar. My name is Anthony Appleton, and I'm a partner in our corporate reporting team. And I'll be joined today by Moses, who will co-present, and in a little bit, Vanessa, who will be dealing with the questions. We expect today's webinar to last approximately 55 minutes. And just a little bit of housekeeping before we start. If you'd like to ask any questions, please use the Q&A function at the bottom of your screen. Time permitting, we'll look to answer your questions as we go through, either through the Q&A function or live. But any that we don't get to, we will come back to you afterwards with answers. Do note, if you click anonymous on the question, we won't be able to come back to you clearly with an answer. We don't cover it in the time. We will provide a recording of the session and along with the slides, and this webinar is appropriate for your self-certification of CPD. So onto the agenda then. On the next slide. Firstly, we'll do our first deep dive into the key changes introduced by IFRS 18. We'll be looking today at the changes that impact the structure of the income statement and looking at transition and effective date. In future webinars, we'll expand that into other areas of IFRS 18. We'll also look at some changes to the UK Companies Act, and what they mean for businesses and your reporting. And then finally, an update on sustainability reporting. With that all in mind ahead of us, I will now pass to Moses to take you through IFRS 18. Thank you, Moses.
Thanks, Anthony. So as Anthony described, this is the first of our deep dives into IFRS 18. One word of warning I would say is that despite everything that we will cover here today, there's probably going to be more stuff that we won't be able to cover. So as with all new accounting standards, the devil is in the detail. So what are the biggest areas of change introduced by IFRS 18? So we're all familiar with IAS 1, presentation of financial statements. That's now been replaced by IFRS 18. It has brought forward a fair amount of content from IAS 1, substantially unchanged. And what are those? Those are there in the middle column here in the slide. The primary financial statement requirements, other than the profit and loss, which is what we're going to be talking about. Frequency of reporting is still the same, comparative information, offsetting, and all those requirements are there, either in IAS 1 or some of them have been moved to IAS 8, which is about accounting policies. So, in terms of what we're going to be covering today, we're going to be covering the first two items there on the list: structure and categorization in the statement of profit or loss, mandatory and additional subtotals, and transition. So MPMs, which is management defined performance measures, is a topic we'll cover at a later webinar, as well as the requirements on aggregation, disaggregation, and certain other miscellaneous changes. At the bottom of the screen there, you'll see a link. So when you get the slides after the webinar, sometime next week, there's a link there to a publication on IFRS 18, mainly on covering today's content plus aggregation and disaggregation. MPMs will be covered in a separate publication at a later date. So who does this affect? Well, basically any entity that is applying IFRS accounting standards, and we'll see later on perhaps others that aren't, but we'll leave that for later. So if we move on to the next slide. So categories and statement of profit or loss. So on this slide here, you will see a P&L account, which probably you might think, well, it doesn't look too different to what I already do. And if you're in that in that group of people, then well done. But there will still be some areas where you will be affected. The first thing to point out here is on the right-hand side here of the slide, we've got categories, and IFRS 18 introduces five categories for categorization of income and expenses for entities that don't have what the standard calls specified main business activities, or SMBAs, as I might call them as we go through this presentation. And it's introduced mandatory subtotals. So you've got their operating profit. Again, a lot of entities already present operating profit, but the introduction of these new categories means that you're now going to be restricted into what you put into operating as opposed to what you might put into the other categories, which are listed out there: the investing, financing, income taxes, and discontinued operations. And today we'll be covering the top three mainly. I will comment briefly on the other two later on, but operating, investing, and financing categories. Worth pointing out that these terms may be familiar to us, and they should be familiar to us from IAS 7. So whilst the terminology is very similar, it isn't exactly the same. So just because you might categorize a cash flow already under IAS 7, say in investing, doesn't mean that activities or that gives rise to those cash flows will also be classified in the investing section of the P&L. Worth also mentioning, there is no such, you don't have to have a section that's called operating section or investing section in your P&L. What matters really are the line items and the mandatory line items. So in terms of the three mandatory line items, you've got their operating profit, I mentioned already, profit before financing and income taxes, and then profit for the year, which is the one at the bottom. Everything else, you don't need to do the subtotals, but you might find them useful. So I mentioned specified main business activities. Those, and as we'll cover those in more detail in later slides. But for those entities that have specified main business activities, the general rules, as it were, change, and we'll touch on them later. But effectively, what having specified main business activities means or will result in is that items that you might have classified in investing or financing get moved up to the operating category. And the reason for that is, if you've got those specified main business activities, then while those transactions might typically be investing or financing for your run-of-the-mill entity, there wouldn't be that. They're not investing or financing for your entity. So if we move on, and we're going to touch now on the investing category. Moving on to the next slide. So we've given you there the paragraph reference numbers. Those are the main ones. There's a whole lot of detail behind those in the appendices and the paragraphs that follow in the standard. So what items drive categorization in the investing category? So we just run through them here: investments in associates, JVs, and unconsolidated subsidiaries, cash returns on cash and cash equivalents, and other assets if they generate a return individually and largely independent of the entity's other resources. So, and the standard also tells you which income and expense will go into the investing section or an investing category: income generated by the assets, income and expense from initial and subsequent measurements, including derecognition. So just going down on the animation there caught me out a little bit. So what's income generated by those assets? Interests, dividend, rental income. So rental income, particularly talking about, let's say, if you've got investment property and that's not your specified main business activity, then rental income from investment property would go into your investing section. Again, that might be an area of change for some entities where you might have put it into, say, other income at the moment, above operating profits. you might, with these changes in IFRS 18, you might have to move them out or down. What are the specified income and expenses? Well, we've got income and expense from initial and subsequent measurement. So impairment losses, reversals, say if we talk about financial assets, fair value gain or loss, and depreciation. This is again something that might be a change. So let's say if you have some investment property which is incidental to your business, so it's not your specified, it's not your main business activity, then depreciation on that investment property will go in your investing category section. Again, you can have separate lines for it, as you might have done now. You might have had other operating income, other operating expense. But that's something that will be moving out of, say, operating profit. And what else can you put in the investing category? So incremental expenses directly attributable to the acquisition and disposal of such assets, which could be, like I said, the associates or investment property. So transaction costs on financial assets at fair value through profit or loss, or costs to sell assets, like broker commission. Again, I think I mentioned it before, but disposal gains and losses. If the assets, while you're holding it, you classify that income as in the investing category, then equally the disposal of such an asset will also go into the investing category, i.e. outside of operating profit. Again, these are just things to be aware of, that could lead to changes. Some other thing, just to mention on this slide, when you have let's say a disposal group that doesn't meet the definition of a discontinued operation, there is a simplification in the standard that allows you to take that all the remeasurement gain or loss on well, it's going to be probably a loss on that disposal group to the investing category. And also worth pointing out that you might think, well, investing is going to be a credit to my P&L. No, it can also be a debit to P&L. So you could have, let's say you have negative interest, which is possible in some scenarios. That doesn't make that into a financing expense, but rather you'd be putting it into the investing category. And all that means is that you might be moving lines up, but it's if we just think back to the mandatory line items, one of the mandatory line items is operating profit. So these types of incomes cannot be above operating profit, but equally there's another mandatory subtotal, which is profit before financing and income taxes, and that is basically the total of operating income and expense and investing income and expense. So again, it's going to be tricky, I suppose, to where you draw the lines, but hopefully the new guidance under IFRS 18 is pretty clear as to where you put that type of income or expense. So moving on to the next slide. And this is something worth pointing out. Share of profit of associates and joint ventures accounting for using the equity method. There's no exception to the classification of that. So that will always be classified in the investing category if the equity method is applied. Now, not everybody knows this, but IAS 28 does allow certain entities to measure investments in associates at fair value through profit or loss. So if you are one of those entities that is doing fair value through profit or loss, then you will be able to classify in certain circumstances when you've got a specified main business activity of investing in associates and joint ventures to put that within your operating profit. But if you do have a specified main business activity of investing in associates, but you choose to measure them using the equity method, that income or expense is always going to be in the investing category. Then income and expenses from cash and cash equivalents. they typically will always be, again, in the investing category, unless the entity has specified main business activities. And the idea behind this is to restrict alternative presentations. You know, I suppose under IS1, it's been a bit of a wild west in terms of categorization. Entities will sometimes choose to put, say, their interest income higher up the P&L. I think this is now going to restrict that to only entities that have those specified main business activities. So again, there's going to be a fair amount of standardization coming out of the implementation of IFRS 18. And I think I already mentioned this, but if you've got a change in the use of an asset, if you have any remeasurements arising from that, so let's say you had an investment property where you were classifying the income as within the investing category, because we said because you don't have a main business activity of investing in investment property, but you then decide to use it for your own business, and let's say that triggers an impairment for argument's sake. That impairment would be classified in your investing activities, but then any subsequent movements, once you change the use of the asset, then that would say go into operating activities. So say depreciation subsequent to the change in use. Worth also pointing out that the standard does not require a subtotal for investing activities. So you could just have your operating profit and list out all the categories of investment category income or expense that you have, and then just tot up the profit before income taxes and financing. Also worth pointing out that not all expenses relating, say, to, I'm going back to my example earlier of where you have, say, some incidental investment property. Let's say you hold that investment property at cost, so the income is going to go through your investing category. Your depreciation would also go through the investment category, but let's say you have some maintenance costs on that investment property, that will not go through the investing category. So it's perhaps a counterintuitive answer, but the standard is quite restrictive on the categories of income and expense that you are allowed to recognize in the investing category. So if we move on to the next slide, and this is we're going to be talking about specified main business activities. So and the specified main business activities goes back to those categories of assets that were mentioned earlier on a couple of slides earlier. But you know, I suppose which type of entities would we argue that might have a specified main business activity and therefore qualify for the different categorization of income and expenses arising from those assets from investing to operating. So we've got the investment property entities. They invest in real estate. Let's say you measure that at fair value. Your income is going to be in the operating category. Your fair value movements is going to be in the operating category. So again, maybe not much of a change for that type of entity. Insurers similarly, banks and other financial institutions. Why would they qualify as having specified main business activity? Because they would invest in loans and financial assets. Similarly, investment entities where you're taking you're not consolidating them because you meet all the requirements of IFRS 10. Then you would again put fair value movements plus any other income that you might get from those investments, like dividend income, interest income, into your the operating category and not the investing category. But it's worth pointing out that just because you might have a specified main business activity, so let's say you are an investment property entity, so you're gonna recognize the income from your investment property assets and the fair value changes in your operating section. If you don't, and let's say you may hold some bonds or gilts which are generating interest income, you would not. So if you don't have a specified main business activity of investing in these types of assets, then the return on those assets would default to the normal categorization, i.e., include them in investing in the investing category. So it's not just that you say, well, I've got a specified main business activity. You've got to define it and say, well, which of those assets are in my specified main business activity? Those you would put into operating. The others you would default to the normal rules. And again, there's I suspect that might be an area of challenge on transition and even going forwards on do you have specified main business activities? Typically, it's a matter of fact, but there will always be some judgment involved in the assessment. Okay, so moving on to the financing category. And again, as with everything in IFRS 18, you've got your general rule, and which means that all entities would have to apply them and put the expenses listed out here into the financing or operating, apart from entities that have specified main business activities. I apologize for the font size. It's I appreciate it. It's a bit hard to see, perhaps, but it'll be in the slide pack when we send it out next week. So IFRS 18 introduces these two categories of liabilities that arise only from transactions that only involve the raising of finance, and what are examples of those? Bank loans, bonds payable, obligation to purchase equity instruments. Then all your interest income and expense. So can we go forward a slide? Yeah. All the interest income and expense and incremental expenses of issuing and extinguishing those liabilities, gains and losses on derecognitions are recognized in the financing category. I think we've gone to the wrong slide. Can we go forward? One more. That's it. Yeah. Then the other category, excuse me, of liabilities that arise from transactions that do not involve only the raising of finance. Again, you can put a fair amount of expenses, or you will have to put a fair amount of the expenses arising from those types of liabilities into financing, but there are other categories of expense that will not fall into the financing category, and they go into the operating category. So and broadly speaking, for those, let's call them type 2 liabilities, is I think what people are calling them now. Interest income and expense and income and expenses from changes in interest rates go to financing, but only if you identify such income and expense applying IFRS accounting standards, i.e. that the standard talks about interest effectively. If it doesn't, so if you think about it, things like cash settled share-based payments, where you have a remeasurement every year, but that remeasurement is just a fair value remeasurement, and whilst there might be some implicit financing in that change in the value of that liability, because the standard doesn't talk about, IFRS 2 does not talk about interest in the context of a cash settled share-based payment, any movements on that, even though it might be due to changes in interest rates or re-estimation, would go to operating category. Also worth pointing out that if you capitalize interest and subsequently you then depreciate that building, the depreciation of that interest element cannot go to the financing category. I think I said method operating, investing for financing. Similarly, modification gains and losses on leases or contract liabilities, those would go to operating categories. If you've got changes to a provision amount, there may be some judgment there as to some of that change might go to operating, and some the bit that relates to the changes in interest or interest rates would go to financing, although clearly how one does that is beyond the scope of this of this webinar. But again, there may be some items that you in the past would have lumped all into one, line item, change the provision. You might have to split it up going forwards. Similarly, any gains and losses on settlement of debt would go to financing, but any gains and losses, say, on the settlement of a supplier invoice, will go to operating, because it's not interest income or expense, or an income and expense arising from a change in interest rates. So again, things to think about that maybe in the past you may have taken them to interest income or interest expense that you won't be able to going forwards. I think I mentioned this as well before, but with regard to investing, but similarly with financing, the standard doesn't require a single line item. You would just go back to the aggregation and disaggregation rules in IFRS 18, which we're going to cover at a later in a later webinar. But there's no hard and fast rules as to how you aggregate. So, there's no hard and fast rules in terms of what you disclose. You just rely on the aggregation and disaggregation requirements and the note disclosure requirements. So if we move on to the next slide, excuse me. So again, as with investing, there are entities that have specified main business activities where you don't go with the default categorization into financing, but in certain circumstances you would put the income and expenses into your operating section of your P&L. And I suppose at this juncture we're talking about, well, what's my specified main business activity and how do I assess it? That's something that's done at the reporting entity level. So if you've got a diverse group, that's something that you would have to assess, as to whether certain activities are a main business activity or not, and if they are, then whether they're one of the specified ones that gets you out of the normal classification and categorization rules. It's not a policy choice, it's a matter of fact, but that assessment will require judgment in terms of what you might look at when assessing whether or not you have main business activities that meet the definition of being a specified main business activity. You might look at your reportable segments and say, well, if something's a reportable segment, and let's say I've got a reportable segment that's I don't know, a money lender, then that probably will inform my view that I have a specified main business activity, and the income and expenses arising from that won't be in financing, but in operating. Other evidence, you might look at, well, what are your KPIs? But I think that's something, as I was preparing for this webinar, thinking probably there's a lot of content there for a future webinar. So if we move on to the next slide, the operating category, I think I mentioned this earlier, it's the residual, and it says so on the slide as well. So what you first do is you assess whether income and expense that you have falls into investing, financing, income taxes, or discontinued operations. If it doesn't, then it goes into your operating category. As with everything, practice will probably evolve over time on this. There's guidance out there, but there are some gray areas that we expect practice to evolve over time, and perhaps regulators to take certain views on the categorization of those gray areas. One of them being foreign exchange gains and losses, where there's some guidance in the standard or some requirements in the standard, but how one applies those to certain scenarios is not quite clear. I said I was going to touch briefly on income taxes. I suppose in the past, people may have included some expenses within the tax section of the P&L that maybe didn't quite meet the definition of an income tax under IAS 12. We expect that this definition will be tightened up a bit by the introduction of IFRS 18, and so therefore, if you do have some taxes that perhaps don't quite meet the definition of an income tax under IAS 12, which is basically a tax on a net amount, that you might want to be revisiting it. There was also an IFRIC on interest and penalties, which said that, if you felt the interest and penalties met the definition of a tax, then you include them in tax, and if not, we expect that situation to persist post introduction of IFRS 18. And this next slide is not going to tell you anything you don't know already, but what would we expect to see included in the operating category? So revenue from contracts with customers. If we just move on to the next slide, depreciation on PP&E, or most PP&E, we say there, because again, as with everything, there's exceptions. Then inventory write-downs, interest expense, NRV write-downs, again, no change there. Credit losses on trade receivables, again, some people might have thought that you could have some grayness there, and it is the grey sector, but so you can't put that in the investing category. It's going to come into your operating category. So moving on to the next slide, and we've covered most of this already, so I'm not going to touch on it very much, but basically those mandatory additional subtotals, the operating profit, which is basically the sum total of all income and expenses in the operating category, and then profit or loss before financing and income taxes, which is the total operating profit or loss plus all income and expense included in the investing category. There is an exception, which is quite a rare one, for entities that have a specified main business activities of providing financing to customers. So you might not see this line, say, with banks, but that depends on certain accounting policy choices that they make. So I don't want to go into much more detail on that, because it is quite complex and possibly not that common. So moving on to the next slide, this is just the same P&L that we showed you earlier, so I'm not going to talk much about it. The one thing I will add is that the requirement to do the attribution of profits for the year to owners of the parent and non-controlling interests is still there in IFRS 18, just in case anybody thought that had gone because of the way we drew up this P&L. So we're going to, excuse me, we're now going to talk about transition and effective date. So the IFRS 18 was issued in April 2024, and the ISB gave a nearly 3-year lead time for implementation, similar to 15, 16, and 9, just because of the recognition that this might involve some work. So sorry, I'll start again. The effective date is 1st of January 2027. So if your calendar year end, your 31st of December 2027 accounts are the first ones where you must report in accordance with IFRS 18. IFRS 18 requires full retrospective implementation. So you're going to have to restate your comparatives, which is normal, so there's nothing new there. If you report quarterly or half yearly, then that will bring forward the date of publication of any interims or financial information prepared in accordance with IFRS 18. Worth pointing out that IFRS 18 made a slight, or for entities that are doing interim reports, you don't follow paragraph 130 of IAS 34, which talks about presenting in a manner consistent with your previous financial year. If this is your first year of adopting IFRS 18, then you present your current year numbers under IFRS 18. Again, there's nothing earth-shattering there. In terms of it's not just your P&L that might be affected by adoption of IFRS 18, just because you might, because of the aggregation and disaggregation rules, which we'll cover at a later webinar, might change how you present those notes as well. So yeah, it's just something to be aware of. If you are an entity that prepares, say, accounts on a 52-week cycle, again, you might want to check when you draw up your 2026 accounts if you wanted to delay adoption of 18 by a year, because if your 27 financial year starts, say, on the 30th of December 2026, you would not be obliged to adopt IFRS 18 for that year. But again, that depends on the commercial decisions behind choosing to cut off your year end. On the next slide, again, just illustrating what reconciliations are going to be required. You're going to have to explain how line items have moved. Say, if maybe under IS1, we have here line items X, Y, and Z, incoming at operating profit. You might have to explain, well, no, we now draw operating profits under line item Y, and IFRS 18 has specific disclosure requirements which replace some of the IS 8 disclosure requirements. Moving on to the next slide, in terms of, well, how you might go about this. Well, you're going to probably have to be looking at your systems and processes and your financial reporting system or your consolidation system, looking at how that all comes together to ensure that income and expenses are appropriately classified. And that's something you're probably going to have to go into a fair amount of detail, digging into, well, how does my subsidiary prepare its financial information? Again, you might need to then think about, well, my systems and processes, because I'm going to have to, either change how expenses are categorized as they come up, say, from subsidiaries. So, that's just something, again, that might take some time to implement. And similarly, we've mentioned here MPMs, which, again, we'll cover at a different webinar. But again, the information requirements for those could mean that you need to strengthen your procedures for collecting information, as that information will be subject to audit going forwards. So if we move on to the next slide, and I just briefly want to touch on, well, how could that affect people who don't do IFRS accounts? So in terms, so the bottom line is that if you're doing UK GAAP, and that could be IFRS 1 or IFRS 102 or IFRS 105, that so long as you're using the formats in the company's act, then you will be largely unaffected, we believe. However, if you are using the adapted formats and thinking about IFRS 101, it's meant to be some sort of IFRS light. It's inconceivable, we believe, that IFRS 18 won't be incorporated into IFRS 101. So for your subsidiary accounts, you might have to go through the exercise of ensuring that income and expenses are appropriately categorized. So again, that's something just, if you're doing 101 or 102, you won't necessarily be able to rest on your laurels if you are doing the adapted formats. So with that brings an end to the IFRS 18 section. I'm going to hand over to Anthony now.
Thank you, Moses. Time for us now to move on to the next section. Oh. Hopefully that's coming through all right. I'm having some strange echo here. Yeah, so the next section is on changes to the UK Companies Act. And if we can move on to the next slide, please. So the first piece is about changes to the company size thresholds. So moving from the IFRS all the way down to micro entities, the government has changed the size limits, increasing them all from by about 50%. So if you have any micro entities, as you can see there, the turnover limit jumps to 1 million, and the current asset limit jumps to 500,000. Remember, on micro entities, those accounts are very simple, very little in them. And if you want to, you can apply IFRS 105. For small entities, we jump to 15 million turnover limit and 7.5 million asset limit, and a similar, 50% jump in medium entities too. Now, these changes, we'll think about what difference it makes in terms of reporting. Remember, small entities, they can apply IFRS 102 Section 1A. That has less disclosure requirements than the rest of IFRS 102. But it's worth noting that, as the speech bubble says in the corner, the recent revisions to IFRS 102 means a small entity will going forward have to do a little bit more than it currently does. Why am I mentioning that now? Well, if you've got, let's say, a June year end, and let's think forward to June 26 year end, you might be in a situation where you were previously medium and you fall down to small. And so you will be able to reduce some of the disclosures and still comply in order to comply with Section 1A. However, I would just be careful with that and just think ahead that 1 year later, because of the changes to IFRS 102, some disclosures might have to be brought back in again. So my advice is, if you're currently a medium-sized company that falls to small, just think ahead to what the new disclosure requirements in 102 for small entities will be, so that you plan for that as well. But yeah, we can see there, effective period is beginning after the 6th of April 2025, and we'll think about the transition position in a minute or two. Just one warning at the bottom, the SECR disclosures, the threshold for them is above medium or large companies. And whilst the medium-sized threshold has changed for the financial statements, it hasn't changed for the SECR disclosures. I mean, I guess in my mind, it was a stupid piece of law writing that, rather than the SECR regulations cross-referencing to the Companies Act section on these limits, it repeated them. And then when these were updated in the Companies Act, they weren't updated in the SECR disclosures. So you've now got this disconnect for what satisfies medium for the purpose of the financial statements and what satisfies medium for the purpose of the SECR disclosures. Just a little anomaly for you to watch out for. You might fall into medium for the first time for accounting, but you will not be medium for the purpose of the SECR disclosures. Moving on to the next slide then, please. As I mentioned, just a quick note on the transition. So in this example, this entity has been at 13 million turnover for 3 years running. In 2024 and 2025, the old thresholds applied, and so for those 2 years, it was medium. Moving into 26, the thresholds change. It's now small under the new thresholds. The rules continue to be that you must meet the size thresholds for 2 out of 3 years. Remember, it tries to minimize you moving in and out. But what this does permit you to do is assess both the current year and the previous year using the new thresholds. So in this case, whilst it was medium in 2025, applying the new thresholds retrospectively to 25, it would have been small. So you're making the small size limits 2 years out of 3. You're allowed to make the move in December 26. Moving on again, please. So that's changes to the thresholds. Some other changes that have occurred are trying to simplify elements of the narrative reporting. Firstly, changes to the director's report. I mean, we're getting to the point really where we can almost shed the director's report entirely. We aren't there yet, but what this has done is significantly reduced again the mandatory disclosures for in the director's report. Partly this is to remove information which is really public policy information rather than information that should really sit in the annual report. But mainly it's to remove replication and duplication, where elements are either already included in the financial statements or they're included in the strategic report. And so hence we see this range of requirements that have been removed, information around financial instruments and risks associated with them, information on branches, information on engagement with stakeholders, both employees and others, and the removal of disclosure of important future developments. Those latter three, for example, all sit better in a strategic report, so the requirement to do them in a director's report has been removed. Again, effective for periods beginning on or after the 6th of April 25. So I guess more likely we're talking about June 26 year ends, if we think most reporting is done on quarter ends. On as well to the next slide, please. As well as reducing the disclosure in the director's report, they've also reduced them in the director's remuneration report for those entities required to prepare one. Quite detailed in terms of the reduction of the requirements that have been removed. Remove certain columns from the single figure table. No longer need to separate fixed and total variable remuneration. No longer need to show the annual percentage change in remuneration for the directors compared to that of the employees. A very detailed point about removing details of changes in exercise price or dates for share options. And then in terms of the remuneration policy, kind of simplifying the disclosure here so that the discussion will end up focusing on what really matters. I think there's a lot in there which is distracting. So removing the section around decision-making processes, moving information on deferral periods, and then a detailed requirements removed around share-based remuneration and director service contracts. Please note the effective date for that is different. It doesn't kick in until beginning on or after the 11th of May. So it will only really make a difference if you have a 1st of May as the start of your next year, but it could make a difference in those rare circumstances. Thank you. Moving on. Now, at the same time as the changes that have been made, we're also in a period of consultation or review at the very least on non-financial reporting. And there will be a consultation in the second half of this year on further changes to the front end, covering the following areas: increasing the employee threshold of medium companies. As we saw a few slides back, thresholds are being changed, but only the financial thresholds around turnover and gross assets. It looks likely they will increase the employee threshold as well for medium-sized companies. At the same time, removing the strategic report requirement for medium companies. So, at the moment, the distinction between what a medium-sized company has to do and one which is large, failing the medium-sized threshold, is actually quite small. This will create a much more significant distinction between medium and those which are above medium, by removing the strategic report requirement entirely. Also trying to streamline where there are many overlapping requirements. Over the last few years, there's been issues around different scope sizes for different sets of requirements, a lot of duplication, particularly in terms of non-financial reporting, overlapping between parts of the strategic report, part of the director's report, other parts of the Companies Act, and also overlapping with things like the listing rules. And the aim is to try and streamline thresholds, streamline the structure of the legislation to make it easier to follow. Some focus on digital formats as well to allow more digital reporting. And then going back to the third bullet point, as part of that, as I say, that's going to really look at non-financial reporting. They will also need to take into consideration making space, if you like, for the new sustainability disclosure standards. We'll come back to sustainability reporting in a little while, but the legislation needs to be cleaned up to better facilitate the introduction of those. Okay, well, with that subject in mind, sustainability standards, let's move on to updates in that area and straight on to the first slide, please. Where we are, well, we've talked previously, or we've introduced previously, IFRS S1 and S2. These are not part of IFRS financial reporting standards, but they're issued by ultimately the same body, the IFRS Foundation, under a different board. But ultimately, these are from the same foundation, and hence they begin with the same prefix IFRS. But it's IFRS Sustainability Standard 1, Sustainability Standard 2. Now, the UK government has been committed to eventually bring these standards into place, into play, and they set up a framework to do that, including a technical advisory committee, and that committee recommended that they are suitable for endorsement in the UK. There's some minor UK amendments, but these have been approved by this TAC. This will create a global baseline, and it'll mean that UK companies that are required to comply with these S1 and S2 in time will be following something consistent with their global competitors. Hopefully provides more decision useful information, because these standards are being targeted on the needs of investors, and will create a single kind of set of requirements to allow larger entities to provide one consistent set of metrics, rather than at the moment where they're having to listen to different calls from different investors for different metrics. The next step is to make this available for use in the UK. So all the TAC did was say to the government, we advise these should be suitable for use in the UK. The next step is for the UK government to consult on changing the legislation to make it possible for companies to use. And then the step after that will be to determine who must apply it. The must will most likely be done by the Financial Conduct Authority, because it's most likely the first group of companies will be those with listings that will be required to follow this. So what we've had so far is these are suitable. The next is to make it permitted through legislation change. The time after that will be to determine the scope of companies that must apply it. And it's likely that will be done by the FCA through the listing rules. There will, however, be available for others to apply instead of the current mismatch of legislative and voluntary requirements. You could volunteer to use these and thereby have consistent information with other larger entities. Moving on. And as I said, we need to streamline the legislation partly because of this, and this is the part that really needs streamlining. At the moment, if large companies are required to apply climate-related financial disclosures, which are in the Companies Act. If you are listed a company, you're having to apply TCFD disclosures, and then some of those are in the center of this Venn diagram that are having to apply both. The two aren't identical. They're very similar, but they aren't identical. And most significantly, TCFD disclosures can be done outside the annual report according to the listing rules, but the Companies Act requirements have to be in the annual report. So we've got this really messy situation which needs freeing up. Now, which needs clarifying and simplifying and to accommodate, as well as I mentioned, the SDSs. Now, what has happened is the FRC has performed a thematic review of what's been done at practice. Now, this shows, we move on to the next slide, we'll highlight some of their issues, but in all honesty, I think some of the problems arise just by that confusion of legislative and listing rule requirements. Anyway, what have been their findings? And remember, this could apply to non-listed because you could be caught by the Companies Act requirements. Very little or insufficient analysis of resilience to different climate scenarios. The FRC recognise that this is challenging and it will evolve over time, but they do expect something, and they've highlighted where there's been little or no analysis. Disclosure of climate targets and KPIs. It's sometimes not clear if you haven't disclosed something because you have no climate-related targets or because you haven't properly disclosed them, or it's not clear what your targets really are. You say you have targets, but then don't properly define them. Unstructured governance disclosures. The disclosures around how you govern climate-related risks are mixed around the annual report and without any coherence or cross-referencing to help people bring it together. Similarly, with the next one, not showing how those climate risks are identified within a wider risk management process. How does it integrate with your broader risk management? No or limit disclosures of climate-related opportunities. For those entities in industries where there are opportunities for them to exploit and take competitive advantage, that we expect them to be disclosing those. Simply disclosures missing. Remember, under the TCFD, that's a comply or explain requirement. Under the Companies Act, you have to do it, and you have to do it in the annual report, which leads to the last one, disclosures not being done in the annual report, possibly because a listed company was following what the listing rules say. But because of this overlap, and they were in the center of that Venn diagram, they had to do the Companies Act ones in the annual report too. So, as I say, rooms for improvement, but also some of the shortcomings are kind of understandable with the current regulatory mishmash we have. So that's what the FRC is saying about the UK. Moving on to the next slide to quickly look at the EU. Why am I talking about this? Well, because some UK companies are caught by this. And they may be caught because they've got certain instruments listed on European markets, or it might be that they have significant business and branches in the EU, and although it's on a phased-in approach, they would be expected to be following these sometime in the future. Well, the European standards are much bigger than just S1 and S2. They cover a whole range of sustainability matters and beyond just those for investors, for other stakeholders too. There's been some pushback in Europe, and so there's been some changes in these requirements. I won't go down into the detail, but effectively what it's done is raise thresholds to take more out of the scope. As you can, and all the bits in red are highlighting the changes. You see the phasing has been pushed back for a couple of years. And ultimately, for those in the bottom group, those non-EU businesses, but with a large presence in there, they have to have a much bigger presence to kick in and with these disclosures in 2028. At the same time, for those of you who are closer to this, EFRAG have been asked to reduce the regulatory burden of the standards they previously issued in time for these phasing in as well. Next slide, please. And this picks up those. Revision to that first set of ESRSs, remove some sector-specific standards, move SMEs from a mandatory standard to a voluntary standard, and looking at reducing the assurance burden as well. All of this may not be directly relevant to you yet, but for many of you, it would have been in the future. In any case, what we see is a real retrenchment from the very ambitious sustainability reporting position Europe were in. And I would say that the UK direction of travel is far more restrictive and really focused on, with a heavy focus at least on climate change. Okay, last slide then, please, to allow me to wrap up. So we've looked at IFRS 18. We looked at the details in terms of the structure of the income statement. Key takeaway, I think, from there is there's devil in the detail. Moz showed you how certain items might move around your income statement, but also things that would have been in one place may now be in two. If IFRS 18 is going to apply to you, you need to have the systems and processes in place by the beginning of the comparative period in order to capture the right information when you do eventually come to report. Change to the Companies Act, thresholds changing. Think through if those threshold changes will impact you. And as I mentioned, do think about the fact that IFRS 1 or 2 requirements for small companies will change soon after. So if you fall into small, I advise you to think ahead to the new small requirements. And I think to be welcomed, reductions in the narrative report and in director's report and remuneration reports. Finally, provide that update and sustainability reporting, which in part has an interaction to the consultations on the Companies Act about cleaning up and clarifying narrative reporting. One more slide. There will be resources available for you to follow and learn a bit more about many of these areas, particularly sustainability reporting and narrative reporting. Links, when we share the slides with you, those links will be there for you to follow and find out more. We have overrun already by a couple of minutes. I don't think there's any outstanding questions. No, there's none open at the moment. Hopefully Vanessa's been answered and we should go along. But if you do have any, please let me, please contact us. But in the meantime, we will send you links to the webinar to watch the recording again and to have the slides and the resource links. Thank you so much for your time and have a great day.